I think that a lot of potential real estate investors get defeated before they ever get started because they hear a lot of lies out there. And I got to admit, I might be one of the ones telling them. When I say things like, I own $25 million of real estate, or have over 150 rental units, or I've flipped over 300 houses, well, I mean it. But when I think about it, it's kind of misleading. And I think that everybody out there who's educating others says things like this, not knowing that what actually happens is it makes you feel like all of this is out of reach and you're never going to get there. So I want to go through the 9 biggest lies that we all tell that makes people feel like they're not going to be able to get out there and make it happen themselves. Starting with number 1, which is, I bought this house in cash. Now, when you hear that, you're right in thinking that, well, this investor must have $200,000 sitting in their bank account ready to stroke a check for that house. But that's not how it works, guys. And in fact, a lot of investors don't have that kind of money sitting in their bank account. There's a really big difference between wealth on paper versus the actual amount of cash you have in the bank. In fact, there's like always a wrestling match going on with, can I build wealth, or do I need to have some cash in the bank because I might not have enough money to buy groceries, which is a fact that happens in this game, that sometimes you run low on cash. And in fact, I've lent money to people to where one little thing goes wrong with their project and they don't have the money to cover it and they have to go borrow more money. I know that I've personally been in the situation where I didn't have the money to finish a project and had to sell my truck off just to get the funds to finish a project so I could sell it on the market and get some money back into my account. So don't let this make you feel defeated. Here's what people are actually doing when they're buying houses with cash. They're getting what's called a hard money loan, or they're raising private money, which means they're calling like their rich uncle and saying, hey, can I have 50 grand as a down payment to put on this house? Which for all intents and purposes is cash. When you go get a hard money loan, it is as good as cash. The person that you're buying the house from is probably not going to know the difference between whether you had the $200,000 in your account or your hard money lender put it there. That's not exactly the way it goes down. But when most people are saying they're buying in cash, they're getting a hard money loan, I promise you. And a little tip for you, even if you do have the cash, sometimes this is the better way to go, because if you're not using your own money, or maybe you're having to pay some fees to a hard money lender, but they're giving you the most of the money to do the project, well, you kind of scale infinitely if you're not using up all your cash. No matter how much cash you have, eventually you'll run out. All right, number 2 is that I own $25 million in real estate. What does that make you think? That, well, this guy must be a 25 millionaire. No, that's not what it means at all. It means that they control $25 million in assets. So let's just say that a house is worth $250,000. Well, if they own 10 of those, that makes for $2.5 million. But if they owned 100, that would be $25 million worth of real estate that they control. But you notice I'm really emphasizing the word control here because they don't own that crap. They have bank loans to buy that property. This is how most houses go. You've heard of the Burr strategies before. Well, people get cash, just like we talked about. Not their cash. They get a hard money loan. They do a rehab on the project, and then they go to a bank and say, hey, since I made this house a lot nicer since I bought it and I put a tenant in it, can you give me a long-term fixed rate loan on this, a 30-year mortgage? And they'll usually give you like 80% of what that house is worth. So let's say it's a $300,000 house. They're going to give you 80% of that, that's $240,000 that they're going to give you. Okay, but just using that example there, you would say, I control a $300,000 house, but you don't own $300,000 worth of it. You only own $60,000 worth of it. The $240,000 loan that the bank gave you minus its value of $300,000. You get what I'm saying? Somebody says they have $25 million of real estate. They mean they control $25 million worth of real estate. I guarantee you they have long-term fixed rate loans on it. Also emphasizing long-term fixed rate loans, because you don't want those balloon loans or variable rate types of mortgages that you can get. You want locked in fixed rate long-term, longest term you can get at the best rate you can get that doesn't change. P.S. That's why real estate is so freaking awesome, is that banks know it's a great investment. So they'll give you 80% of the value of the house. Huge leverage. You need a small amount of cash to be able to control a humongous asset, a $300,000 asset. That's beautiful. You can't do that with stocks. Except for some people in the comments will say, well, if you do a blah, 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 blah. All right, whatever. Yeah, I'm sure there's some advanced strategies, but you can go to a bank right now, get 80% to go buy a house. And in fact, if you buy your own house, a primary residence, somewhere where you're going to live, you can get like 97% of that financed. And if you're a veteran, I think you can get even more. So there you go. Guys, it's the way to go. I don't care what they say. Stocks are stupid. Maybe it's because I don't understand them. But anyway, 3 is I bought this house for 50% of market value. All right, this comes up all the time. And people are like, oh, I can never get started because like these deals don't exist for people like me. It's only for insiders that have been doing this for years and have some kind of special contacts. No, not at all. Here's what it means when you buy a house of 50% of market value, which what that means is other people would have to pay $200,000 for it. You can pay $100,000 for it. That's how great of a deal you get. This is what they don't tell you about that. So it is true, just like these other things. They are true, but it's a little bit misleading. That means that, yes, they did get that because it needs a humongous renovation. Like I can go buy a $200,000 house right now for $100,000 that's condemned and is going to need a crap ton of work. A lot of risk that I'm taking on. Of course, risk that is backed by a lot of experience and being able to do that. That's why you should watch my other videos, maybe hit the subscribe button because we talk about a lot of those things. But anyway, 50% of market value, well, you ought to be getting it at 50% of market value if you have to use all of these skills that you acquired to make it worth more money. Other point here is that more than likely they did not buy this house on the market, which means like buying it on Zillow or on the MLS through a real estate agent. Most likely they bought it off market and they probably bought it direct to seller. And well, the way that they bought it direct to seller is they spent a whole lot of money on marketing to line up this deal. Maybe they sent out a bunch of mail. Maybe they made a bunch of cold calls or hired people to make cold calls. On average, it would take me like $3,000 to $5,000 of marketing to find one deal. Okay, now obviously on this $200,000 house that you get for $100,000, well, of course you would take that. If you only had to spend $5,000 to find it, why would you not do that? Well, a lot of people don't because let's just say it costs about 50 cents, maybe $1 per piece of mail that you send out, depending on how nice of a piece of mail you send out. Sometimes we do like the handwritten stuff and sometimes we do the cheaper yellow letters. But anyway, let's say it's $1 a piece of mail to send out. I send it out to 5,000 people into the ether. Sometimes I get 0 phone calls. All right, you just blew $5,000. That's pretty dang scary for a lot of people. So big risk equals big reward. Fortunes favor the bold. Next is they have a great team. All right, now when I would hear this before I really got into the game, I would hear this and I would think, gosh, these guys have like all these employees working in some office somewhere. They have like contractors who are at their beck and call, and they have property managers in-house, real estate agents and CPAs and attorneys, and they're all sitting around a table talking about the best things for your business, and everybody gives high fives and like goes to dinner together. No, it's not like that at all. Okay, all of these guys are vendors to them, meaning they're 1099s, not W-2s. For those of you that don't know, a W-2 means they're an employee on your payroll. You pay them every other week, no matter what happens. A 1099 is a subcontractor. You pay them via some sort of contract that you have with them, like a real estate agent. You're going to pay them 2% of a house that they sell for you. So they sell the house for $200,000. You're going to give them 2% of that, which is $4,000. And here's where it's really BS. All right. Because I think that they lead you to believe that these guys are like sitting around a table and they're all talking about, that investor's business. And maybe if they're a humongous investor that's doing like hundreds of deals per year, and there are people out there like that. And in fact, I have scaled up to where we were doing that many deals in a year. And you definitely do get put first in line with a lot of different vendors. However, no matter how big you are, you have to realize that you are second priority to them, because first is them growing their business. So yes, if you're a big investor like that, you might be their top customer, but you are only a piece of their pie, not the whole thing. All right. And further yet, is I think that the building a great team thing in general is bad advice, because I think it leads people to give blind trust to these different experts out there and just like, oh, well, they know what they're doing, and so I'm just going to hand that piece of the business over to them. No, I don't think even the biggest and the best ones do this. I think what the biggest and best investors are actually doing is they understand exactly what that vendor is supposed to do. They understand the job, they understand the expectations, and they lay them out really well for them. So that's how they build a great team. It's not that they've built a great team necessarily. Certainly they've found great companies and vendors to work with. But the real thing that they've done is they have built great skills inside of themselves. And you hear me say this all the time. That's the real wealth in this game. You build those skills. You own them. You don't farm that out to anybody. Next, I own 150 doors, or I own 150 units. Well, here's what that makes you think, that these people own 150 houses outright. Well, remember earlier we talked about the whole loan thing and a 30-year mortgage. So outright doesn't mean outright. It means they control 150 units. All right, well, that's a lot of houses. And I hear a lot of them out there that are like thousands and thousands of units out that they own, like big apartment complexes and such. And this is the thing that I want you to understand. They do not control that themselves. There are partnerships. There are funds. Basically, what they have done is they have given up a lot of the pieces of the pie. In fact, most of the pieces of the pie. They have a little slither of the pie, but they have chosen to go the route of creating a humongous pie. Okay, that's fine if that's a strategy that you want to go after. I just want you to know that when you hear that somebody owns thousands of doors, well, kind of. But it's not like they went out there, they bought a house, they put a renter in it, and then they refinanced it, and then they did another one. No, they raised a whole bunch of money or partnered up with a whole bunch of people with a whole bunch of money, and then they went out and said, hey, I want to buy these 100 houses from this person, and I'll take a little tiny slither of that humongous pie. So for a lot of people, owning 100 doors that way is pretty similar to owning 5 yourself. And you can do that in like a year if you do it right. Hey, another point where you should like and subscribe. You got it. Okay. Next is I paid 0 taxes. Now, there is no doubt about it. Real estate, in my opinion, and a lot of other people's opinion, is the best way to mitigate your tax expenses. But the whole paid 0 taxes thing, what that usually means is they deferred their taxes. They kicked the can down the road. There are things like 1031 exchanges where you do a like-kind exchange. You sell a house for $200,000 and then buy another house for $200,000 or more. You don't have to pay the taxes on the first house you sold. There's a whole bunch of rules with that, which we're certainly not going to get into today. Okay, so you don't pay any taxes in that scenario, but when you sell the house that you bought through the 1031 exchange, you would pay taxes. So you've only kicked the can down the road. Now, these strategies can go on and on and on and on and on, but it's not what you think, where you just free and clear, I don't have to pay any taxes because I'm a real estate investor. Okay, there's also the fact that if you gain rent income, there's the phantom deduction of depreciation. But once again, that's only a deferral. You're kicking the can down the road. Eventually, you'll have to pay those unless you strategize in a different way. A lot of strategies there, and there are ways to actually do that. But you are not just outright, I took $1,000, put it in my pocket, and I don't have to pay any taxes at all on it. It doesn't work like that, except for in this one scenario. You sell your primary residence, your personal house that you live in. You've lived in there 2 out of the last 5 years. There's a couple more rules, but you can take $500,000 of gains on your primary residence when you sell it and put it in your pocket and not have to pay a red cent of taxes on it. That's like the only way I know of that you actually don't have to pay any taxes. $500,000 if you're a married couple, $250 if you're single. But I mean, that's a lot of profit. You'd have to do really well on a house to have that much profit in a house. But this is why a lot of people will buy a new house to live in every couple of years, because they're kind of flipping those houses and putting the cash in their pocket. Okay, next is I made $100K on this flip. Okay, this one is like tremendously misleading. And this is actually not one that I do. I kind of like this one, and the next one I'm going to tell you are lies that really make me angry, because they're more like outright lies. You're like leaving out information that is almost intentionally misleading. But on the other hand, there are reasons why you might leave that stuff out, because if you put it in there, there's a lot of explanation that you have to do. So let me get to it here. All right, when you go to flip a house, let's say you sell it for $300,000. Let's say you bought that house for $150,000 and you did a $50,000 renovation on it. So bought for $150,000 plus the $50,000 renovation, $200,000 you have in the house. You sell it for $300,000. There you go, $100,000 profit. That's really easy to understand, right? Even like the backwards way I just explained it, you still understood it really well. All right, but that's not the reality, because you sold that house and you had to pay closing costs. You had to pay real estate fees. You know, even if you don't have your own realtor and you're a FSBOer, you still had to pay the real estate agent on the other side. Of course, there's some people thinking out there, well, not the way that I do it, because I do some, I make the buyer pay the real estate agent. Whatever. I mean, if you did that, then you didn't sell the house for $300,000. You sold it for $295 instead, because you get it. Whatever. All right. So you're paying some when you sell it for $300,000. So you're already losing like 10% right off the rip there. So instead of $300,000, sold it for like $270. Okay, so my $100,000 profit is already down to $70. But then there's other things that are left out in that $50K renovation. Like most people, like we talked about, are going to get a hard money loan, which is usually around 12% interest over the year. And usually you have to pay some points on the front end, almost like a setup fee, let's say. So I always figure my hard money loan for the duration of having it at least like 15 to 20%. So for easy math, if I bought the house for $150,000, had to do a $50,000 renovation, I borrowed $200,000. So I probably paid $30,000. Yeah, that was right. Around $30,000 in interest, maybe $20,000. Let's do $20,000 for easy math here. All right, so I have $200,000 acquisition plus renovation plus $20,000 in interest. So I'm already at $220,000 of cost. Then, the sale was $270 after I took out those fees. So already I'm down to a $50,000 profit. Okay, but then I got to pay utilities. I got to pay for insurance. I have to pay closing costs when I buy it. I have to pay, like we talked about earlier, maybe marketing fees to find that deal that was such a great deal. I'm sure there's other things that I'm leaving out here because I'm kind of ripping this information, but there are other costs is the point. So your $100,000 spread is not actually $100,000. But what if I had to explain all that crap every time I said, oh yeah, well, we made X amount on this. And that's why people do it sometimes. And sometimes they do it to sound really cool, because that's cool to make $100,000. Next is like the ugly cousin of that one, which is I make $300 a month on this rental. All right, same kind of deal here. Usually what people are doing is, okay, I make $1,500 a month from my tenant, and my mortgage payment, which is principal, interest, taxes, and insurance, because the taxes and insurance you usually escrow on your payment. All right, my payment to the bank is $1,200 a month. So $1,500 I make from my tenant minus the $1,200 I have to pay to the bank. $300 a month. Sweet deal. Cash flow, baby. Hashtag, right? But no, that's not the full picture here. Usually you're going to hire a property management company. So that's usually like 10%. You have to do lease ups, or if you're leasing it yourself, you're paying marketing expenses and using a bunch of time to try to lease it out. But a lease up fee is usually like half a month's rent. You're paying maintenance, which I always plan for like 7 or 8% a month. You have to figure in for vacancy. Let's just say like 1 month out of the year, every year is vacant, or a little bit less after a rental gets seasoned, because you'll get good tenants in there from time to time, but take out another 7 or 8%. CapEx, you definitely want to put aside money because eventually that roof is going to go out, or your HVAC. That's different than maintenance. CapEx is different. So you have to take out for all of those things. So obviously you can see in this $1,500 a month example, minus the principal, interest, taxes, insurance, you're going to be in negative cash flow after you figure in the real expenses. So don't get caught up in that. Most people, first time they buy a rental, definitely think they have a great deal and find out later they don't. General rule here that I follow is the 60% rule, which I'm not going to work out the math, but basically it says that if I rent it for $1,500 a month, I'm going to plan on a net operating income of about 60% of that. Now that is including my taxes and insurance, not the principal and interest though. And then finally, number 9, my favorite, is I flipped 300 houses. True. But what that would lead you to believe is that that individual bought, did a big rehab, a renovation, and then sold those properties. Well, people kind of like intermix the word flipping, which is the process that I just explained, and wholesaling, which is really flipping contracts. I have this house under contract to purchase for $100,000. Would you, other investors, sir, buy this house at $110,000 and I'll make the $10,000 difference instead of ever buying the house? All right. Well, wholesaling, you can do lots of those. At one point we were doing, like 10 a month of wholesale. Not quite 10 a month. It was like 100 in 1 year was the best wholesale year that we had. Okay. But that's a lot different than actually putting out the money to buy a house and then renovating it and then selling it, or even a wholesale situation where you actually buy the house, you take ownership of the house, and then immediately turn around and put it on the market to sell to other investors. Certainly different levels of risk and bandwidth that are being taken in each one of those strategies, but a lot of times people kind of call all of that flipping. And I don't really care about the terms. What I care about is in this video that you don't hear those things and think that this is out of reach for me, because the reality is, guys, even the investors who have been at it for a while, myself included, there are struggles. I mean, you're wrestling with things every single day, and it's not super easy all the time. That's not meant to be discouraging, which I just heard myself talk and it sounded pretty discouraging. Just the point is, these guys don't have it perfect. It's a struggle. It's not as great as it seems. And so don't feel like it's out of reach for you, because it is in reach. All you need to do is have some skills, which is knowledge times experience. So eventually you got to get out there and actually take action. But before you do that, you don't want to get stopped up completely. So you want to gain as much knowledge as you can. YouTube is a perfect place for that. And I just so happen to make a whole bunch of videos. This one right here, you should watch next. Have a good day. Thank you.